If you have recently explored buying a home, you most likely have come across Zillow, a company that may look simple on the surface, but is actually highly complex with numerous segments engaging in a wide array of real estate related activities. With earnings set to be released in a couple of days, I wanted to break down the stock and look at the bull and bear case from a long term perspective. Officially known as Zillow Group Incorporated, the company is best known for their website Zillow.com, where prospective home buyers or just simply curious people can check for homes for sale, property values, property history, and even tax rates. In reality, Zillow is much more than that, operating two major segments, including the Internet Media and Technology division, known as IMT, and the Homes and Mortgages segment. Obviously, with the coronavirus and everything that comes with it, there has been some serious players questioning the financial health of the company. Real estate is not something you want to be involved with in a recession. We learned that from 2008, and for a company that makes its money almost exclusively in that sector, you can guess the stock price will be quite reflective of that reality. IPOing in 2015 for about $27 a share, Zillow has experienced some ups and downs. Most recently, during a sudden rally starting in October of 2019, the company went from about $30 a share to $65 a share in a mere 4 months, doubling in price before coming to a sudden and drastic crash following the news of the virus. From February 21st to March 20th, Zillow's stock price fell from $65 a share to $27, with investors uncertain about the state of the real estate market here in the United States. After more and more information has come forth regarding the virus, and as the stock market rebounded off the March lows, Zillow has enjoyed a rally in price as well, coming up from about $44 a share. What the future holds is largely dependent on the state of the market in 12 months' time, how much the real estate market moves relative to expert estimates, and how the US and world react to a second wave in the winter of 2020. One of the major outcries from bears is the Zillow IBuyer program, which makes Zillow not just a tech company with a cool website, but a company that is directly involved in owning and selling physical real estate. The way it works is relatively simple. In select markets across the United States, you can choose to sell your house to Zillow directly. Zillow will take possession and put that house on the market after the fact and hopefully make a profit. You might be asking how they do this, especially since they explicitly state on their site that they don't flip homes. They look for houses that are in good or great condition. The simple answer to that is that they lowball. Anyone who has tried to sell their house will tell you just how time-consuming and horrible the process may be. What Zillow essentially offers is a way to sell your house in days with no hassle. They have other incentives that we will outline later, but basically it's a way to dump your property and receive your money quickly. You will of course pay a convenience fee for this, and you will not get nearly as much money as you would selling it traditionally, but it does help eliminate a couple of things. You don't have to refresh anything, no painting, staging, touch-ups, nothing. You also don't have to deal with a realtor who's going to take 4 to 6% of your selling price. And most importantly, you don't have to worry about talking to first-time home buyers, the customers. This program has been relatively successful, surprisingly, as there are always people in the middle of a messy divorce, relocating for work, getting rid of rentals, in the middle of a contingent offer on another house, or selling remotely to make this a worthwhile venture for them. As a result, Zillow owns thousands of homes, and if the market is indeed free-falling, this is obviously a huge financial liability for the company. They make their money from real estate transactions along with these sales. If prices plummet and demand falls, it's easy to see where the stock price is headed. This is why you've seen dozens of so-called financial experts come out and speak on this subject, stating that companies like Zillow, Redfin, and etc. are headed towards a whirlpool of bankruptcy, and buying puts will make you rich. The truth, however, is a lot more complex than that. Zillow's business model is actually quite genius. For a homeowner who wants to buy another house, selling a home is even worse, and experienced sellers know this, especially when you have to sell your starter home to a first-time buyer. A typical Zillow customer that is someone who bought a house years ago in a hot market understands that his or her house is usually worth about $100,000 more than what she or he paid for it. There are a lot of people who would give up $20,000 of that not to deal with the whiny children and their crappy agents who still haven't figured out how to use an e-signature. Along with other reasons I stated earlier, Zillow has a significant inflow of sellers who are extremely motivated to sell and use the Zillow iBuyer program as a way to get a zero-hassle selling quote for their house. Zillow understands that the vast majority of people who initially press the Sell to Zillow button on their site see their renovation-adjusted lowball offer, laugh, and move on. However, like all things, it's not that simple. Zillow just now had an opportunity, which is a parallel part of the Zillow evaluation process, to have a conventional real estate agent present a comparative market analysis to this highly motivated seller. And this agent has already agreed to pay Zillow a significant referral fee if the seller ends up listing and selling in the open market instead. It's a win-win. If you're not educated on the real estate industry, then you don't know how much that lead is worth. So I'll tell you. On a $200,000 house, an industry standard value seller lead is $2,000. Keep in mind that they basically had to do almost no work to get this lead into the funnel. Unlike other sites, Zillow has already established itself as the go-to for home buying, and sellers flock to it. Zillow has tens of millions of homeowner visitors a month. Because they have already built a monster consumer media machine, they can eventually just pass that seller lead, which they paid nothing for, to an agent for several $1,000s. And the small percentage of sellers who really want out now and are willing to pay a fee, well, Zillow wins not just in one way, they roll their winnings and double up. Remember, these are repeat home buyers. They have to go somewhere after they sell. Then Zillow is there with certainty and cash. And of course, they're right there with associated home and moving related services like a mortgage. Side note, Zillow bought a mortgage company. Why does this matter? Well, Zillow can make offers only they can provide in this market. Because of their sheer size, they can and will offer best-in-class incentives to use their mortgage and associated services, which will allow them to capture hundreds of additional basis points per loan from sellers who want to use Zillow to streamline the whole transaction for them. For an example, if you sell to Zillow and use a Zillow mortgage to buy your next house, they will give you $4,000 in credits to use towards closing costs and never have to deal with a buyer again. And on top of that, they will do this without building out any significant new ad spend or marketing funnels. If you are in the process of buying a home, you can understand how archaic and dumb the entire process is, and as I just stated, Zillow is really doing genius level work to get that simplified. But we are talking about now. What's going to happen to Zillow after this virus? They actually just announced they're completely stopping the iBuyer program, which must mean they're bearish on home prices in the near future. And that's absolutely true. For every real estate agent you talk to who states that the market is going to be fine, there's another economic paper that comes out to blow that theory away. The truth of the matter is that nobody knows. There's a lot of uncertainty with the current economic environment, with unemployment shooting up and the Fed printing endlessly. Nobody can accurately forecast home prices, but most people agree that things do not look good. But once again, it's not that simple for Zillow. In one of the grossest forms of financial engineering, Zillow surprisingly understood that owning so much property is a giant ticking time bomb. Anybody can read the balance sheet and see that the company has a giant stain on its total liabilities line, but that doesn't matter. Zillow loves using something called non-recourse debt or a non-recourse loan. That's a loan that is secured by a pledge of collateral, typically real property, but for which the borrower is not personally liable. Basically, the loans that Zillow took out for these properties are contained inside special purpose financing vehicles that are tied only to the underlying homes. If they wake up tomorrow and decide that holding all these properties was going to screw them, they could walk away from every single home and not pay the creditors. These facilities were designed this way on purpose for exactly this kind of scenario. On top of all this, the company has a gigantic pile of cash that they're sitting on, mostly from a set of financing offers that the previous CEO nailed down. This cash comes from a combination of selling new stock and new convertible bonds. Most of you are probably thinking convertible bond. Well, if the stock isn't X number, the bondholders will just demand the money back instead. But you would be wrong. Unlike every other tech company bond out there, This conversion is at Zillow's option, not the note holders. So if they blow all their cash on anything before the note comes due, they can just run the Xerox machine for a couple of hours and hand out some newly minted common shares. All of these complex inner workings make me question the bear case against Zillow. There are very good arguments for both sides, but given the financial engineering and complex strategy, Zillow is more gray than black and white. It's hard to say where the stock will be headed next. The company still faces significant risk. Even if we recover from this virus as if nothing had happened, the long-awaited deep recession is coming. This overinflated market running since 2009 will eventually crash, and with it will come the home prices. What happens next is that there is no saving Zillow or any other leveraged startup. Thank you guys for watching. Please make sure you comment below with your thoughts. I appreciate all the views. All opinions are welcome.